Welcome back to The Real Accountant. Ratios are a useful tool that allow us to explore a firm's profitability and liquidity, and they help managers and accountants identify areas for improvement. But out in the real world, the use of ratios goes much further than this. Today, let's explore how they can be used as a tool to identify and assess strategy, and how they are a key component of making investment decisions. Last time, we explored how budgets are a powerful tool to plan strategies and implement change within a business. Ratios reflect the implementation of strategies. We can use them to start to pull apart the story behind a company's financial reports. Just by performing a few simple calculations, we can identify what strategy a firm is following and how effectively it has been implemented. We might even be able to identify a company just from analysing its financial reports. Here we have the ratios of two large retail chains that you can find all across Australia. Let's perform some basic analysis and see if you can guess what these two companies might be. We can see that the ratios look quite different and reflect that these two companies take very different strategies. Knowing that these are retail companies, we can discover a bit more about their strategy by analysing how they generate a profit. Looking at the asset turnover and profit margins will help us out here. Company A has a much higher asset turnover of 3.9 times compared to Company B at only 0.46 times. This gives us an indication that given the relative size of the two companies, Company A has a much higher volume of sales. While Company B does not sell as much, we can see from the gross profit margin and especially the net profit margin that for every sale that it does make, it generates a higher profit. A net profit margin of 18.3% means that for every dollar of sales, Company B makes just over 18 cents of profit, while Company A only makes 3.7 cents of profit. We could also look at ratios like inventory turnover. We see Company A only keeps its inventory on hand for an average of 24.5 days before it is sold, while Company B is much longer at over 95 days. Here we can see the two companies are following very different strategies. Company A is following a cost leadership strategy. To make a profit, they make a large volume of sales at low selling prices. They most likely sell fairly low-cost goods that move in and out of the business quickly and are bought often by consumers. Company B follows more of a product differentiation strategy. They make a profit by selling a smaller volume of goods, but at a much higher price than they cost. They most likely sell high-priced goods that aren't bought so often. Now that we've identified the different company strategies, can you guess what retail chains we've been analysing? Before we reveal our mystery firms, ratios are also a very powerful tool used by investors when making investment decisions. They allow us to compare the relative performance of different companies and assess profitability and liquidity. But ratios aren't always what they seem. Say I were to give you $1,000 to invest into either Company A or Company B. Which one would you choose? A lot of you probably lean towards Company A, seeing that it has a much higher return on investment. However, in the 6 months leading up to the figures these ratios are calculated from, Company B actually performed much better on the stock market. Its share price rose by 29% compared to just a 15% rise for Company A. It's important to note that ratios are just a guide to help make investment decisions. They provide a high-level picture of the company, but there are a lot of other factors to consider when making a real investment decision. So, were you able to guess what the two companies are? Well, If you chose Company A, you'd now be a shareholder of Coles. If you picked Company B, you would have invested your money into Harvey Norman. Just by analysing their financial reports, hopefully you were able to identify these two businesses. Ratios are a powerful analysis tool we can use both within and external to a business. As an accountant, they let you investigate the performance of a firm and start to discover the story behind the numbers. Thanks for joining us today. Like and subscribe for more real-world content, and we'll see you next time.